welcome. Where? Inda, Dumalang, Molo, Sawubona, Hukandat, and a warm welcome to the Induvo Knowledge Cast, the podcast where your curiosity meets insightful conversations. Today, we're going deep into IFRS 7. That's International Financial Reporting Standard 7, for those who like to use the full name. Now, I know what you're thinking. Financial reporting. Really? But trust me, this is way more relevant to you than you might think, especially if you're an investor, own a business, or just, care about the health of the economy here in South Africa.
Absolutely. You see, IFRS 7 is all about transparency in the financial world. It's like shining a spotlight on all those complex financial instruments that companies use and demanding they come clean about the risks. And understanding these risks, well, that can make a real difference when you're deciding where to put your hard-earned rands.
Okay, so let's break this down. First things first, what are we even talking about when we say financial instruments? Is that just like a fancy way of saying cash, bonds, stocks?
Well, you're on the right track. It includes those things, but it's broader than that. It includes any contract that creates a financial asset for one party and a financial liability, or equity instrument for the other. So think derivatives. So those contracts, their value is based on something else. It's like, I don't know, when your mates make bets on which team will win the Curry Cup, but on a much larger scale.
Okay, so essentially we're talking about like the building blocks of a company's balance sheet.
Right.
And IFRS 7 is like the rule book that makes them come clean about the risks hidden within those building blocks.
Exactly. Think of it this way. You're about to buy a house. Big investment.
Yeah.
You're not just going to take the seller's word for it that everything's perfect. You'd want to get a home inspection and cover all the hidden problems. IFRS 7 is like that home inspection. But for a company's finances, it helps us see beyond the glossy brochures and understand the real story behind the numbers. Okay, that's an analogy I can get behind. But before we go full-on home inspector mode, let's back up a bit. This standard IFRS 7, how did it even come about? It didn't just magically appear one day.
No, you're right. IFRS 7's had a bit of a journey. It was first issued back in 2005, replacing an older standard that was mainly focused on banks. But the financial world, it's constantly evolving, with new instruments popping up and new risks emerging faster than a taxi driver in rush hour traffic.
Oh, yeah. So IFRS 7 is to kind of adapt. And stay up to date. Or it'd be as useful as a chocolate fire guard.
Exactly. That's why. It's been amended several times since its initial release. Each amendment is like a software update, patching up any weaknesses, making sure it stays relevant in our ever-changing financial landscape.
Okay, so IFRS 7 is getting all these updates. Can you highlight some of the major changes that have really impacted the financial game here in South Africa?
Certainly. Back in 2009, after that global financial crisis shook the world, there were significant enhancements to the disclosures around fair value and liquidity risk. Remember those dodgy mortgage-backed securities? That brought the whole system down.
Vaguely. It was a while back.
Wow. That whole mess highlighted the importance of transparency around how companies value their assets, especially those tricky ones that aren't traded on a daily basis. And, equally important, whether they can actually pay their short-term debts without having a meltdown.
So this amendment was all about making sure companies weren't hiding any dodgy assets or pretending to be flush with cash when they were actually running on fumes.
Spot on. It forced them to be more upfront about their financial health and how they were managing those crucial risks.
Transparency for the win. What other amendments stand out?
Well, in 2010, there were new rules introduced for transfer financial assets. This was to tackle those sneaky off-balance sheet structures that some companies were using to hide risky assets. It's like trying to hide a whole herd of Nguni cattle in your backyard. Sooner or later, someone's going to notice.
So IFRS 7 wants to shine a light on those hidden crawls and make sure everything is accounted for.
Precisely. And then in 2011, there was a focus on netting arrangements and offsetting. This is basically how companies can use their assets and liabilities to cancel each other out. So it's a bit like saying, sure, I owe you 100 Rand, but you also owe me 50, so let's just settle up for 50.
So it's all about simplifying the picture. But it could also be a way for companies to make their financial position look a little bit rosier than it actually is.
Exactly. That's why IFRS 7 demands companies to be very specific about how they're using these arrangements so that investors aren't left scratching their heads, wondering what's really going on.
Okay, so we had the 2009 update on fair value and liquidity risk, the 2010 one on those hidden assets, and the 2011 amendment on offsetting those liabilities. Anything else?
One more big one. In 2019, there were some big changes related to interest rate benchmark reform, you see. Globally, there were some major scandals around the manipulation of these benchmark interest rates. Think LIBOR.
Ah, yes. The one that brought down a few big banks.
That's the one. So there's been a global push to transition to more reliable alternative rates. Here in South Africa, it's the JIBAR, the Johannesburg Interbank Agreed Rate. That's being reformed.
So IFRS 7 had to be updated to make sure companies are disclosing how this transition to a new benchmark rate is impacting their financial instruments and risk management strategy.
Exactly. It's all about keeping up with the times and ensuring transparency in the face of these major market shifts.
Okay, so we covered some of the key amendments to IFRS 7. But let's get real. This is all well and good for the accounting whizzes. But what does it mean for the average person in South Africa?
That's the million-rand question. Let me give you a few scenarios where understanding IFRS 7 can make a real difference in your life. Imagine you're thinking about investing in those unit trusts. Your bri buddy keeps boasting about.
Ooh, unit trusts.
Fancy. Well, the disclosures required by IFRS 7 can help you peel back the layers and understand the risks associated with those unit trusts. What kinds of financial instruments are they holding? What's their exposure to credit risk, market risk, liquidity risk? You can find all that information in the fund's financial statements. And it can help you make a more informed decision about whether it's the right investment for you.
So IFRS 7 is like
Yeah.
having X-ray vision into the inner workings of those investments.
Think of it as your financial decoder ring. It helps you understand the secret language of financial statements and make smarter choices.
I like that. The financial decoder ring. Okay, so it helps with investments. Are there any other ways this impacts,
Yeah.
the average South African?
Let's say you're applying for a home loan to finally get your piece of the South African dream. Banks use IFRS 7 disclosures to assess the creditworthiness of companies, especially if those companies are your employer. So if you're hoping to move into that dream home, you better hope your employer has good IFRS 7 disclosures, showing they're managing their risks properly.
Wow, I never thought of it like that. So our personal financial lives are intertwined with the financial health of the companies around us. And IFRS 7 helps us see those connections.
Precisely. And it goes even further than that. Think about the bigger picture. Transparency in financial reporting is absolutely crucial for a healthy economy. It builds trust and confidence in our financial system, which is essential for attracting investment and creating jobs.
Right.
Remember all these financial scandals we've had in South Africa recently?
Yeesh, don't remind me. State capture, Steinhoff.
Exactly. IFRS 7 and good financial reporting in general are key weapons. In the fight against corruption and financial misconduct, they help to hold companies accountable and prevent those kinds of scandals from happening again.
Okay, so this isn't just about boring accounting rules. It's about creating a more transparent and accountable financial system for all South Africans.
Absolutely. It's about empowering everyone, even those who aren't accountants, to understand the financial landscape and make informed decisions.
I'm totally on board with that.
Wow.
Now, we've established that IFRS 7 is important, but let's be honest, it's also quite complex. There are all these different types of risks that companies are required to disclose. Can we break down those risks and understand what they actually mean?
Certainly. Let's start with credit risk. This is the risk that a borrower might not pay back their debt. Think of it like lending money to that friend who's always forgetting their wallet.
Oh, yeah. We all have that friend.
Right. Now imagine a company lending millions to other companies or individuals. That's a lot of potential forgotten wallet.
Right. So credit risk is about who might not be paying their bills. How does IFRS 7 help us understand this risk?
It requires companies to disclose a ton of information about their exposure to credit risk, for instance. They have to tell us their maximum exposure to credit risk, essentially how much money they stand to lose if all those forgetful friends suddenly disappear.
Ish, that doesn't sound good.
It's crucial information for investors. They also need to tell us about the quality of the collateral they're holding to secure those loans, like a backup plan in case those loans go sour.
Okay, so if a company is lending money to risky borrowers, but has good collateral, like maybe a prime piece of land or a valuable painting, that's less worrying than if they have nothing to fall back on.
Precisely. IFRS 7 ensures that this information is crystal clear and accessible to investors and anyone else who's interested.
Okay, so credit risk is all about managing those forgetful friends. What about liquidity risk? What's that all about?
Liquidity risk is the risk that a company might not be able to meet its short-term financial obligations. So you can think of it like making sure you have enough cash to cover your month-end debit orders.
That's a feeling we all know.
Exactly. Now imagine a company having to pay salaries, suppliers, and those pesky loan repayments. They need to have enough cash readily available. Otherwise, they could find themselves in a bit of a financial bind, even if their long-term prospects look good.
Yikes. So what does IFRS 7 require companies to disclose about this liquidity risk?
Well, it requires them to provide a maturity analysis of their financial liabilities. This basically tells us when their debts are coming due and how much they need to pay. It also requires them to explain how they're managing their liquidity risk, which might include things like having access to lines of credit or holding a certain amount of cash on hand.
It's about making sure they have enough cash on hand or quick access to funds to cover those short-term bills.
Exactly. They need to prove they can keep the lights on and the wheels turning.
Okay. So we've got credit risk, which is all about managing those borrowers.
Yes.
And we've got liquidity risk, which is about making sure that the cash flow is smooth. What's the third type of risk?
That would be market risk. And this one's all about how a company's financial position could be impacted by changes in market prices. Think of it like checking the petrol price every week. You never know what you're going to get.
Tell me about it, especially here in South Africa, where the rand seems to have a mind of its own.
Exactly. Market risk can include things like changes in interest rates, those pesky exchange rate fluctuations, and even swings in commodity prices.
So if a company has a lot of debt in U.S. dollars and the rand weakens against the dollar, that's going to put a dent in their profits.
Precisely. And if they're reliant on imported raw materials,
Right.
those price swings can really impact their bottom line.
Okay, so market risk is all about navigating those unpredictable market forces. But how does IFRS 7 help us understand how well a company is managing this particular beast?
Well, IFRS 7 wants to make sure companies are disclosing their sensitivity to these market movements. So they have to provide what's called a sensitivity analysis, which basically shows how their profit or loss and equity would be affected by changes in these key market variables.
So it's like a what-if scenario. What if the rand weakens by 10%? What if interest rates jump by 2%?
Exactly. It helps investors understand how vulnerable a company is to those external forces that are often beyond their control.
Okay, so companies have to tell us how susceptible they are to changes in things like interest rates and exchange rates. But how do we know if they're actually doing a good job managing these risks?
That's where those qualitative disclosures come in. Remember those from earlier. Companies need to tell us about their objectives, policies, and processes for managing each type of risk. They also need to describe the methods they use to measure risk and how those methods have changed since the last report.
Ah, so it's not just about the numbers. It's about understanding their risk management game plan and how they're tackling those potential problems.
Precisely. The qualitative disclosures provide the context we need to make sense of all those numbers they tell us, whether the company is just paying lip service to risk management or whether they're actually walking the talk.
This is starting to make sense now. We've explored the history of IFRS 7. We've seen how it impacts us, ordinary South Africans, and we've delved into the nitty-gritty of those three main types of risk. But let's be honest, reading through those financial statements can still feel like trying to decipher ancient hieroglyphics. Any advice for our listeners on how to, make sense of it all?
That's a great question and a common challenge for many. Don't worry, you don't need to become a chartered accountant overnight. Let me give you a few tips to navigate those financial statements like a pro. First things first, don't get bogged down by the numbers alone. Remember those qualitative disclosures we talked about. They're your secret weapon. They give you valuable insights into the company's risk management strategy. Look for clear explanations of how they identify, assess, and manage each type of risk. If the explanations are vague or lacking detail, well, that's a red flag right there.
So if a company just throws out a line like, we manage credit risk, but doesn't tell us how, that's a sign they might be hiding something.
Absolutely. They need to be specific. What criteria do they use to assess creditworthiness? What are their policies for collateral? And credit enhancements. The more detail they provide, the better. It shows they're taking risk management seriously and not just trying to sweep it under the rug.
Okay, so pay attention
Yeah.
to the quality of those qualitative disclosures. Got it. What else should we be on the lookout for?
Always be on the lookout for red flags. For example, has there been a sudden jump in a company's credit risk exposure? Do they offer vague explanations? For changes in their risk management strategies, these could be signs that something's not quite right. It's like when your friend suddenly starts flashing around a brand new German car, but claims they won it in a lucky draw. You know something's fishy.
I knew it. So IFRS 7 is like,
financial lie detector test. It helps us spot those companies that might be trying to pull the wool over our eyes.
Think of it more as a smoke detector. It's not foolproof, but it can alert you to potential problems early on, giving you a chance to investigate further, or maybe even get out before things go up in flames. Okay, that's a good way to put it. A smoke detector for your investments. Okay, so pay attention to the qualitative disclosures. Look for red flags. Any other tips for navigating these financial statements?
One more crucial tip. Don't just look at one company in isolation. Compare their risk profiles and risk management strategies to their competitors. This can help you assess relative risk and make more informed investment decisions. It's like when you're buying a car. You don't just settle for the first one you see. You shop around, compare different models, and see which one offers the best value for your money.
That's a great analogy. It's all about comparing apples to apples, seeing how companies stack up against each other in terms of risk.
Exactly. IFRS 7 gives you a framework for comparing companies on a level playing field, so you can make those informed decisions.
I love how you're making IFRS 7 sound less like a chore
Yeah.
and more like a powerful tool for investors.
It absolutely is. And remember, these disclosures are readily available. You can usually find them in a company's annual report or on their website. And don't be shy about reaching out to the company directly. If you have any questions, they should be able to provide clear and concise explanations.
Transparency is key.
Right.
Okay, let's put these tips into practice. Can we walk through a real-world example of how we'd use IFRS 7 disclosures to assess a company's risk profile?
Absolutely. Let's take a company many South Africans are familiar with, ShopRite. Imagine you're considering investing in ShopRite. What are some of the things you'd want to know about their risk management practices?
Well, first things first, I'd head straight to their annual report and look for the section on financial instruments and risk management.
Right. I got it. That's where you'll find all the juicy details. Now, remember our first tip? Focus on those qualitative disclosures. ShopRite is a retailer, heavily reliant on consumer spending. So I'd pay close attention to how they describe their management of credit risk.
Because if consumers are struggling financially, they might not be able to pay their bills. And that would impact ShopRite's bottom line.
Exactly. Look for information on their credit policies, how they assess the creditworthiness of their customers, and what they do to recover outstanding debts. Do they have a robust process in place? Are they being proactive?
So if they have a thorough credit assessment process and strong debt collection practices, I would suggest they're managing credit risk effectively.
Precisely. On the other hand, if they're loosening their credit policies just to boost sales in a tough economic climate, that could be a big red flag. It might signal that they're taking on more risk than they can handle. Remember, sometimes a sudden increase in sales can be a bad thing if it's driven by risky lending practices.
Good point. It's easy to get caught up in those positive sales figures, but we need to dig deeper and understand what's driving them. Okay, so we've looked at credit risk. What about liquidity risk? How would we assess that for a company like ShopRite?
For a retailer like ShopRite, managing inventory and supplier payments is crucial. They need to make sure they have enough stock on the shelves to meet customer demand. But they also don't want to be stuck with a warehouse full of unsold goods.
It's a delicate balancing act, especially in today's unpredictable market.
Exactly. Look for disclosures about their inventory management practices and their payment terms with suppliers.
Yeah.
Do they have a well-oiled system in place to ensure a smooth flow of goods and payments? Do they have access to short-term financing if they need a quick cash injection?
Okay, so it's all about efficient operations and having a backup plan in case things get tight. What about those maturity analyses we discussed earlier? How do those come into play here?
Remember, the maturity analysis gives you a clear breakdown of when those short-term debts are coming due. This is vital for understanding whether ShopRite has enough readily available assets, like cash or those quick-selling items, to cover those payments without breaking a sweat.
So if they have
Yeah.
a massive debt payment looming in the next few months, but their cash flow is looking weak, that could be a sign of trouble brewing.
Precisely. It might suggest they'll have to scramble to meet those obligations, perhaps resorting to more borrowing, which could be costly, or even selling off assets at a discount, which could hurt their long-term financial health.
And selling off assets in a fire sale
Yeah.
is never a good look.
Right.
It makes investors nervous and can send those share prices tumbling faster than a spring buckwinger on a try-scoring run.
You got it. It's all about maintaining that financial stability and showing investors they've got things under control. Okay, we've covered credit risk and liquidity risk. for ShopRite. What about market risk? What are some key things we'd focus on there?
As we talked about earlier, the exchange rate is a constant headache. For South African businesses, it's like, okay, hoof, try and hit a moving target. With those load-shedding schedules, you never know what's coming next.
You said it. And ShopRite, with its reliance on imported goods, is particularly vulnerable to those exchange rate swings. A weaker rand means their import costs go up, squeezing those profit margins.
So I want to see how they're managing their currency risk. Do they have hedging strategies in place to protect themselves against those unpredictable fluctuations? Are they using any financial instruments to lock in more favorable exchange rates?
Excellent point. Look for disclosures about their hedging policies and how effective those hedges have been in mitigating the impact of currency movements on their financial performance. Remember, hedging is like taking out insurance against those unpredictable currency swings. It's not about making a quick buck. It's about minimizing potential losses.
Okay, so hedging helps smooth out those currency bumps. In the road, what about interest rate risk? Is that something we should be concerned about with a company like ShopRite?
Absolutely. Most companies have some exposure to interest rate risk, especially if they carry a lot of debt. If interest rates rise, their borrowing costs go up, putting pressure on those profits. So it's crucial to understand how much debt they have, what kind of interest rates they're paying, and how that debt is structured.
So I want to see if they're locked into fixed interest rates or if they have a lot of floating rate debt, which could become a real burden if those rates start climbing.
Exactly. Look at the maturity profile of their debt. Are those big repayments due in the near future when interest rates might be higher? It's all about understanding their interest rate exposure and how they're managing it.
This is a lot to take in, but it's fascinating to see how we can use IFRS 7 to get a real sense of a company's risk profile.
It is fascinating, isn't it? And remember, you don't need to become an accounting guru overnight. Just focus on those key areas we've discussed. Ask the right questions and do your research. Compare different companies, look for those red flags, and pay attention to those qualitative disclosures. It's like being a financial detective, piecing together the clues to uncover the real story behind those numbers.
I'm loving this detective analogy. Speaking of uncovering secrets, IFRS 7 also requires companies to disclose information about transfers of financial assets. Could you shed some light on that? It sounds a bit technical.
Like it can be, but it is important to understand, especially if you remember those off-balance sheet maneuvers we talked about earlier. Remember those hidden crawls?
You mean companies trying to make those risky assets disappear like a magician's rabbit.
Exactly. IFRS 7 shines a spotlight on those tricks, demanding that companies disclose details about any transfers of financial assets, even if those assets haven't completely vanished from their balance sheet.
Okay, so it's about preventing companies from cooking the books and making their financial position look better than it really is.
That's the idea. Now, there can be legitimate reasons for transferring financial assets, things like securitization or factoring, which are common practices. In the business world...
Securitization. And factoring. Remind me what those are again.
Sure. Securitization is basically when a company bundles together a bunch of assets, like maybe those home loans we talked about earlier, and sells them off as a package to investors. So it's a way to raise capital and free up their balance sheet. Factoring is when a company sells its unpaid invoices, its receivables, to a third party at a discount to get cash more quickly. It helps improve their cash flow, especially if they're dealing with those forgetful friends who take their sweet time paying their bills.
But those can be legitimate business practices. But IFRS 7 wants to make sure that companies are being upfront about these transfers and that they're not using them to hide any nasty surprises.
Precisely. They have to tell us about the nature of those transferred assets, the risks and rewards still associated with them, and any continuing involvement they have.
With those assets.
Continuing involvement, what does that mean exactly?
It means that even though they've transferred the assets off their books, they might still be on the hook for some of the risk. For example, they might have provided a guarantee to the buyer of those assets, promising to step in if things go south, or they might be obligated to repurchase those assets under certain conditions.
So it's a bit like selling your old backy, but promising the buyer that you'll cover any major repairs for the next year, so you're not directly responsible anymore. But you're still exposed to some risk.
That's a perfect analogy. IFRS 7 wants to make sure that all those details are out in the open, so investors and other stakeholders can get a complete...
That accurate picture of the company's risk profile.
I'm starting to see why IFRS 7 is so important. It's like, oh, financial watchdog, making sure companies are playing by the rules and not trying to pull a fast one.
Of investors. That's a great way to put it. It's all about transparency, accountability, and giving everyone the information they need to make informed decisions.
We've covered a lot of ground today.
And having
thankfully,
what's more about it?
about navigating the world of IFRS 7. But before we wrap things up, I have one more question. We've talked extensively about the risks companies face. But what about the flip side? What steps can companies take to strengthen their financial resilience and weather those economic storms?
That's a fantastic question, and one that every company boardroom should be grappling with, especially in our current economic climate here in South Africa. It's not enough just to identify and disclose risks. You need a solid plan to tackle them head on.
So it's about moving from defense to offense, taking proactive steps to build a financial fortress that can withstand those inevitable shocks.
You got it. And the foundation of that fortress is a robust risk management framework. This isn't just about ticking boxes for compliance. It's about deeply understanding the specific risks a company faces and developing a clear, comprehensive strategy to manage them.
So it's like having a financial game plan, a roadmap to navigate those tricky situations.
Precisely. This includes having robust systems in place to identify, measure, monitor, and control those risks. It's about being proactive, anticipating potential problems, and having a plan to address them before they become full-blown crises.
Oh, it's a bit like those fire drills we used to have in school. Preparing for the worst, but hoping for the best.
That's a great analogy. And it's not just about having that plan on paper. It's about making sure everyone in the company understands it and follows it. This requires strong leadership, clear communication, and a culture that truly values risk management.
Okay, so a solid risk management framework is like having strong foundations. For that financial fortress, what other building blocks are crucial?
Diversification is key. Think of it this way. If you put all your eggs in one basket and that basket falls, you're left with a big mess. The same applies to companies if they're overly reliant on a single product, one particular market, or just a handful of suppliers. They're much more vulnerable to those unexpected shocks.
Makes sense. Spread the risk, spread the love.
Right, exactly. Diversifying their revenue streams, broadening their customer base, and building a resilient supply chain can help companies weather those economic storms much more effectively. It's about having multiple pillars to support their business.
Now, what about debt management? That seems pretty important, especially with interest rates being as predictable as load-shedding schedules these days.
You're absolutely right. Prudent debt management is crucial for building financial resilience. Companies need to carefully consider their borrowing levels and make sure they can comfortably service their debt, even if interest rates rise. It's like making sure you can still afford those bond repayments, even if those pesky rates climb higher.
So don't just jump at the first loan offer that comes your way. Shop around, compare those interest rates, and negotiate those terms.
Exactly, and don't be afraid to restructure or refinance that debt if their financial situation changes. It's about being proactive and adapting to those ever-changing market conditions.
Okay, so we've got debt management, diversification, and that robust risk management framework. Anything else companies to focus on?
To fortify their financial fortress.
Last, but certainly not least, strong corporate governance is the bedrock of it all. This includes having a competent and independent board of directors, clear ethical guidelines, and transparent financial reporting. It's about having a solid foundation of integrity and accountability.
So good governance is like having a solid foundation for your house. If the foundation is shaky, the whole structure is at risk, no matter how beautiful the walls are.
Perfect analogy. Strong corporate governance helps to ensure that risks are identified and managed effectively, that those financial reports are accurate and reliable, and that the company is genuinely operating in the best interests of all its stakeholders, from employees and suppliers to investors and the wider community. This has been an incredible journey into the world of IFRS 7. We've gone from deciphering this complex standard to understanding its real-world impact here in South Africa. We've even explored how companies can use these principles to build a stronger, more resilient financial future.
It's been a pleasure unpacking all of this with you. Remember, knowledge is power, and IFRS 7 gives us the tools to understand the complexities of the financial world, make informed decisions, and hold those companies accountable.
Absolutely. Well, That brings us to the end of another insightful deep dive here on the Indubo Knowledge Cast. We hope you've enjoyed this deep dive into the fascinating and, dare I say, thrilling world of IFRS 7. Who knew financial reporting could be so exciting?
Until next time, stay curious, stay informed, and remember, when it comes to your finances, knowledge is your best investment.